I'm very pleased to welcome you on behalf of Clayton Utz to our panel discussion, Insuring Your Future, Superannuation, Insurance and COVID-19. Today, we'll be examining some of the issues arising within super and insurance policies and legal implications that have arisen as a result of the coronavirus crisis. My name is Nerida Secker. I'm an actuary and director at the Heron Partnership. My fellow panellists are Chris Sinclair, Head of Group Life, Mercer Marsh Benefits, and Jane Paskin, a former partner, now consultant at Clayton Utz. Okay, so Chris, can I start with you? How prepared do you actually feel the insurance industry was for this event, particularly of the magnitude of it?
Yeah, that's a really good question, Nerida. Ultimately, the life insurance industry is prepared, considering life insurance is about the long term. So from a capital perspective, there's certainly not many concerns. I think it's more from a practical perspective. There are some challenges like there are in all industries, right? And we're all experiencing that. I'm not sure there's many of us who have experienced a pandemic of this nature and this scale during our working life. So when you think about, the way insurance contracts are constructed, the way services have been designed, they certainly haven't been done so with this type of event. So the industry is certainly working collaboratively to respond, focusing on three, key broad areas. So the first one being services around claims and medical underwriting. The second one being continued policy coverage. And the third one being pricing and risk appetite. And they're really in the order of priority. So the absolute priority is to ensure that, today, tomorrow, and next week, services are still being provided, claims are still being paid, which has been challenging with social distancing, the impact on the healthcare system. But insurers have all been adapting to that and providing leniency and different ways of providing information and different ways of assessing disability claims. So we haven't seen any interruption in terms of claims being continued, which has been really fantastic. One of the second most important issues are people still insured during this time? And are people still insured when, employers are taking measures to preserve the strength of their business into the future? So that's, the challenge that the industry is working through right now. When you think about...
So from the employer's perspective, in terms of their issues, what should they really be focusing on? What should they be thinking about?
Yeah, for sure. There's probably four key areas for employers to be thinking. The first one and the most important is if there are temporary adjustments with their workforce. So if they're looking at pay reductions on a temporary basis, reduced hours on a temporary basis, or people being stood down or on leave without pay on a temporary basis, what does that mean from perspective? Does insurance continue during this period of time? Is it at the same level that employees enjoyed prior to taking a temporary adjustment in their employment arrangements? So that's quite a big challenge at the moment, because the black and white of insurance contracts would say that in some instances people are no longer insured, and in some instances the level of cover would reduce with someone's earnings. However, recognising that that's...
Sorry. In terms of those contracts and things, I've had lots of calls from from employers, and different insurers are actually dealing with it in different ways. Like last night, I saw a question and answer thing get sent round by Hanover. Oh, I just mentioned insurer's name, but they've actually got an interesting approach where they're looking back at the employment position back in March. So, and they're offering, ignoring any reductions. So that's quite an interesting thing. But that was on death and TPD. They were silent on income protection, which is where the greatest differences are. So it is interesting, I think, how some of these things are playing out.
Yeah, absolutely. And there's a lot of inconsistency right now, and there's also some insurers who are still trying to form an opinion. So I think, for the industry, it's, the focus is to try and get a position, and then how do we make that consistent, and how do we then ensure that for employees and employers, they're in, a position that is no worse off than what they were prior to any temporary adjustments to working arrangements.
And Jane, we know with these policies, sometimes it's really the employer's responsibility, sometimes it's a trustee, sometimes it's a member. Who should really be worrying about and dealing with these things?
Probably all three in some respects. If we start with the member, there is the point that Chris just made about the black and white nature of policies. Often it's the member who's expected to, in the superannuation fund, contact the trustee and say, I've just gone on leave of absence and, et cetera, et cetera. But I also, and as a trustee director myself, the overwhelming responsibility of the funds to get good information out to their membership and what's sitting on their websites and how you're communicating with your members. And then really employers, and it's all three sort of groups are trying to do the right thing. And, obviously employers these days want to be good employers, and being good employers means trying to help your staff through the issues that they're facing right now. So I think it's a little bit of everybody, and it's how we all work together that's going to be important.
And Chris, clearly, potential reduction in benefits and protecting those and understanding what some of those changes might be and how to mitigate them. What are some of the other issues that employers should be thinking about at the moment?
Yeah, for sure. One of the other issues is if people are being stood down or on furlough leave and there's no expected return to work date, what does that then mean from an insurance perspective? Insurance contracts are written that where someone is on a leave of absence, they are still to be insured, subject to there being a expected return to work date. So that's a really important thing to consider and factor that into the way an employer goes about preserving their workforce and the strength of their business into the future. So, be engaging with your insurer, with your broker, with your super fund, to really understand the practicality of that and ensuring that there's no inadvertent loss of cover when the intention and of all parties is that shouldn't occur. There's a couple of other points to think about. Cash flow is obviously a really important one at the moment, and a lot of our clients and a lot of employers are pay premiums annually in advance. They're taking a hit from a cash flow perspective. The industry is certainly working to support organisations from that point of view. So, if an employer typically paid an annual premium in advance, it can be quite a significant sum. Insurers and their brokers and super funds are looking for ways to support organisations from a cash flow perspective. So looking at different frequency of premium payments, different payment terms. So certainly support available from that perspective, and employers should be engaging with their brokers and super funds and insurers to discuss those options.
So what about the employees? Lots of questions are popping up for them. I know I had one the other day from an employee, clearly a connection, but it was a self-interest question where they're saying, should I take leave without pay versus should I, use up my annual leave? Will that vary my benefits? And in terms of the insurer that they were dealing with, it was going to have an impact. But what are some of the other questions that you're coming up with or hearing about, Chris?
Yeah, for sure. Some of the key questions we're hearing are, if I lose my job as a result of redundancy or I'm no longer receiving pay, will income protection provide me with benefits? And the answer is unfortunately no. So, these policies provide benefits in the event of illness or injury only and not related to redundancy or loss of income for reasons other than illness or injury. The other common question is, COVID-19, it's a pandemic. What does that mean? Is there an exclusion? In some other insurance classes, there are exclusions relating to pandemics. In the most part, there is an exclusion perspective, which is great. So in the unfortunate event someone has a long-term disability or worse as a result of this pandemic, insurance will certainly pay out. There are some nuances to consider with various insurers and their policy terms. For example, one insurer does have a pandemic clause, however, they have to enact that for it to be active, and they haven't done so at this stage, and we don't expect them to do so. Some other insurers look at, when people are overseas, noting that cover is 24/7 worldwide. If there's a DFAT rating for do not travel, they would typically not provide cover for individuals when they are overseas. However, these are, extraordinary circumstances, and insurers are taking a common sense approach there. So employers need to think about that, ensure that they understand their terms of their policy, think about what that means from their workforce. Do they still have individuals travelling for work where it's required overseas, or do they have employees who are travelling overseas for medical emergencies with families and that? Employers really need to engage in policy terms and what it means for them, their workforce and their people.
Certainly I'm aware of a one super fund that is self-insured that does have an exclusion on it, but it is only in respect of new cover, and it's only some of their members, not all of their members, that get impacted by this. So it is interesting, and people will need to just check with their super fund what their arrangements are to make sure that's not a problem. Jane, are you aware of any others, any super funds that are, or any circumstances?
I'm not, but just going back to the conversation that Chris was having, and reflecting sort of on the terms of some policies, individuals flipping into less hours than what the policy actually requires you to work to actually have cover. So often that's like 15 hours if you're working, if your hours have been reduced significantly. So that's a question I think everyone needs to be asking, where you've got workers with significantly reduced hours. And another one that's come to mind is I review sort of superannuation complaints and AFCA cases, and I write the super verdict article that's in Super Funds magazine for Clayton Utz, actually. But there was one that I was writing about the other day, and this employee had lost cover as a consequence of becoming unemployed for a short period, and had gone back into the same fund and actually had been re-employed by one of the employers that they had been in that fund before. And the rules in that situation required full underwriting. He wasn't able to get automatic acceptance and automatic cover, and as a consequence, with a medical condition, he wasn't able to get cover at the amount that the individual wanted. And in fact, that particular insurance company wanted to have an exclusion for that pre-existing medical condition. And I sort of thought about that one. I thought, oh, that's an issue that we might see where we have people lose cover in the pandemic, but then go back when we see light at the end of the tunnel into the workforce, and whether some of these rules we might have to think about those again.
It's interesting. What about?
Sorry, Nerida, I was going to say, Jane, that's a really good point, because there's lots of unintended consequences. It really highlights the need for employers and employees to be really engaged to understand their particular circumstances, what's going on in their organisation, and then what that means. Because there are lots of these unintended consequences that do need to be addressed to ensure that people are in a no worse off position.
What about mental health? Potentially there's going to be additional cover, additional claims, coming through. It's very sad, but what do we see? What are we expecting here?
Yeah, it's an interesting one. I think there's certainly a correlation between economic outlook and so there's certainly an expectation that there's going to be a spike in mental health. Where someone is unfortunately suffering, diagnosable illness, and they're under the care of their GP or psychiatrist, then insurance will be there to support these people. Important thing is to, for an employee perspective, is to think about outside of the financial protection that insurance provides, how can you help an individual get back to life, back to health, and back to work? And that's where insurers and employers have a key role to play, to identify these cases early when people go off work and to provide the appropriate rehab and support services to help these individuals get back to their best life and back to work.
I'd like to just comment a bit there. I'd love to see that we don't waste this crisis on that point that you're just making there, Chris, because going back a little bit, there's a little bit of turf war between the life insurers and the health insurers about who pays for what and what's your business turf. But if you really just all step back, if we all step back and say what we want is people who get well fast, who we surround them with the proper allied health services to enable that to happen, and they get back into the workforce and have great lives. So I'd just like to see us not waste this crisis and really come up with some solution. And obviously that would need some government intervention anyway, but what we currently have, especially in income protection, where people could actually be better off just staying sick and collecting the money according to the terms of the policy, so certainly someone say 75% of their pre-existing salary. Well, it doesn't really encourage people to get back to work. And that's what the industry's got to look at going forward.
So, increased claims. What do we see is going to happen with premiums? What do we think about this?
Yeah, it's an interesting one, isn't it? No doubt increased claims beats increased premiums. For the industry, they've got to really take a step back and think about insurance is here for the long term. When there's spikes in claims, is that tolerable? Is that expected when you look at over the long term? I think the industry is also, today far better at helping people, far better at managing claims. So will claim duration rates from this spike be different to perhaps what's happened in past economic crisis, the GFC, etc.? I would say yes. However, all parties certainly need to work together to address that. I think prior to this pandemic, the life insurance industry was already struggling. It's well reported that the retail sector reported over $1 billion in losses last year. The regulator has stepped in and said there's certain policy terms that need to cease to get back to a level of sustainability. You throw over the top with the protecting your super and PIMF changes have happened in the superannuation sector, where up to $2 billion in premiums have exited the sector. There's going to be some challenges and concerns. You throw in the fact that insurers do earn a level of profitability from investments, and with the interest rate environment and where that's gone, that's going to be a significant impact on investments, but also on reserves that are required to be held for claim liabilities. So premiums are certainly going to be on the rise. What that overall impact is, probably will depend on where the economy goes. So is this a temporary blip for 2020? Will we exit this crisis in reasonable shape, or are there going to be long-lasting impacts? That will have a direct correlation to, not only claimed experience, but also to where premiums are going to head as well.
I suppose the other thing, Chris, too, isn't it? What kind of policy terms and claims management will change as a consequence of just larger numbers of income protection claims going on?
Yeah, absolutely. And, the industry is almost in a perfect storm, right, in that over the past period, premiums have been the driver of improving sustainability, whereas claims and policy terms have lacked to some extent. I think, to your point, don't waste a crisis. I think this is really going to bring to the forefront a key focus on policy terms that better support people and better support insurers to engage with claimants and individuals, and claims management approaches that better support people as well, to help them get back to life and work and really bring that to the forefront. The life insurance industry no doubt is behind the curve in respect of that when you compare to some other personal injury industries such as workers' comp. So there's absolute opportunity to evolve and change and to use this pandemic as a positive to really bring those to the forefront, because adjusting cost isn't a sustainable approach.
So what about the actual employers? Is there anything that they can actually do to mitigate, to prevent having a big increase in premiums? Like, is there something that they can be doing at this stage?
Yeah, certainly. So there's, it's still evolving right now what the exact corporate sector is going to be from a view. However, there's certainly opportunity for employers to look at various things to mitigate the impact for themselves. So, often insurers take a broad brush approach and say this is the approach we're taking across the industry, whereas many employers are in a strong position and they're going to come out of this in a position and they're taking measures to ensure they do. So, it's upon employers to work with their super funds and then with their brokers to engage with their insurer to understand what their insurer's position is and to help the insurer understand the employer's position, their industry position, and what that is going to look like in the future to ensure that you're able to, essentially sell your risk into the insurer so that they understand you in a deeper way and that, premiums are reflective of the risk you are rather than the risk that they perceive you to be. So there's certainly an opportunity to mitigate any cost increases by taking that type of approach.
And ideally, if you could possibly put off any re-rate back until mid to late 2021, I presume. If you could, I'm not sure that's going to be possible. But,
yeah, absolutely. That's a good point. Often employers' policies renew on 1 July, and if your rate guarantee period is coming up over the next 3 months, there's going to be concerns because the industry is trying to work out their overall position in advance of seeing what actually plays out over the next 12 months, right? So, if you're able to work with your insurer to defer for 12 months, yeah, absolutely. I would be putting my hand up and asking for that and accepting that.
And some of the reinsurers might not be too happy getting involved in some of the cover right now either. So if you were forced to tender right now, it'll be an interesting time, I imagine.
Yeah, absolutely. Insurers and reinsurers risk in a certain way at the best of times. So they're certainly looking at things now in a more stringent view. So it is going to be challenging, but there's opportunity in the face of. So it's really, looking at, what the opportunity is here and how to work together in a collaborative way. Often reinsurers have sat in the background to some extent, and that's their role, right? And this is a real opportunity to bring them to the forefront and to be on the front lines and understanding risk in a deeper way.
So before I shift over to Jane to talk a bit more about some other superannuation impacts, is there anything else that you want to draw out on in terms of insurance before we shift direction?
No, I think that's, we've covered the key points. I think that, the key for employees to consider is that insurance is there, it's always going to be there, but it's not designed to ordinarily respond to this type of circumstances. When you think about policy terms, you think about the way employers are looking to preserve their organisation and ensure that they are strong coming out of this. So you just have to engage, ask questions, speak to your insurer, speak to your super fund, speak to your broker, and really work together collaboratively to understand what it means for your organisation, what it means from an insurance perspective, and what the solution is there to ensure that there are no unintended consequences.
Okay. All right. So, Jane, shifting our focus more to some of the other superannuation issues that are arising. So, the job seeker payment, maybe if you could talk a little bit about that and is SG payable on it? If you could cover those things, that would be great.
Okay, let's go. So we're talking about an employer who's applied for the JobKeeper, and that's the employer collecting the $1,500. So the short answer to all of this is we're expecting the Superannuation Guarantee Administration Act to be amended and some special rules put in there. And in the meantime, we've got a fact sheet that the Treasury has put out. And so the short answer is SG payable. The answer is yes. But then you can think of lots of little different examples. And I think it's worthwhile for me just to sort of carry on a little bit and just sort of consider some of those examples as I mentioned in the Treasury fact sheet. So we'll have hypothetical Anne, and Anne is earning $1,500 a week, so $3,000 a fortnight. Her employer has applied for JobKeeper, so the employer is collecting the $1,500, but it's going to continue to pay Anne $3,000. Now, that's so that Anne's just basically on the same salary that she used to be on, and that employer would just continue paying the SG, same as before. But then I'd hope to say the hypothetical Nick, and Nick was earning $1,000 a fortnight before. JobKeeper's coming along. Nick's going to be taking home $1,500 a fortnight. What's the employer got to do? Has the employer got to pay SG on $1,500 or $1,000? So the short answer is the $1,000. And interestingly, the Treasury fact sheet says the employer has the choice to whether they're going to pay SG on the extra $500. So watch that space. And then, of course, we have to, maybe say working at my local yoga centre, and they're not going to work at the moment, but they're going to be collecting the JobKeeper payment, so they will be being paid that $1,500 a fortnight. But they're not turning up at work at all, so they're effectively being stood down. That's the kind of a situation I'm thinking of. They won't be SG paid, because when someone's stood down, an employer doesn't have an obligation to pay them. They're paying that individual the $1,500 because of what COVID's, what we've introduced here as a society to get money into the community. So to the funds, which have high numbers of members who have been stood down, they're not going to be receiving and shouldn't be planning on receiving.
Okay. Well, what about the members that can access this $10,000 from the super fund? And they can do it this financial year and then early part of next financial year. Who's able to do that? Who's entitled to do that?
Yes, well, so as you just said, it says $10,000 for just before the 30th of June, and then you can get another $10,000 in the first 3 months of next financial year. So pretty quickly $20,000 if that's the amount that a person had in their superannuation fund. And who's entitled to do this? It's the unemployed, for first start off, and then others who are on some other form of social security payments like the youth allowance or the farm household allowance. And then we get into another level of people who are able to do this, and that's where they've had a 20% reduction in their salary, or say a sole trader who's had a 20% reduction in the amount that they've been able to earn. So there's quite a lot of people who will qualify to be able to apply to take some money out of their super fund. And in fact, the ATO is going to be sort of providing the support around all of this. So this is how people go and apply for it. They have to go on the MyGov website, and they basically fill in an online form with the ATO, and the ATO are going to be then deciding whether that individual satisfies the criteria. The ATO will then be telling the trustees of the super funds who actually have a requirement to pay up as soon as they reasonably can. So, yeah, that's probably the short answer. Probably went on a little bit long there, but over to you, Nerida, again.
No, that's okay. So what are some of the hidden impacts of people withdrawing these funds from their super?
Oh, there's quite a few. And on that point, I think there's a real need for the trustees to be putting some good information up on their websites and emails and any other way in which they can contact their membership. So overwhelmingly, you think this is probably going to be younger people who might have lower account balances, who will be dipping into their super in these COVID times. And one of the things that will happen there is if they take all of their money out, they will lose their life insurance. The other point is that they might be when they get back into the system, it will take them a while before they have $6,000 in their fund, and then they won't be able to have insurance going forward unless they decide to opt in. So I think there's those insurance ramifications from taking money out. People need to absolutely be aware that that is happening to them. And then, of course, these individuals are getting money out of the fund. They're capitalising even when the market's poor, so they're capitalising on their losses, and they're not going to have their money in that system to have a rebound. And the other one, of course, just to think about is what is the long-term implications on their retirement savings. I have read some research, and I'm assuming it was based on someone taking out the full 10,000 and then another 10,000, so a total of 20. But, you know, that having sort of 120,000 cost at retirement for somebody taking out money now in their 20s. Chris, do you have any other views about, especially around the insurance point?
Yeah, I think you're spot on, Jane. It's those unintended consequences, and Australians ordinarily, have a positive outlook on life and don't think the worst is going to happen to them. And but they need to be really conscious of doing something that loses their insurance, but also doing something that means they may not have insurance for 12, 18, 24 months. When we know, unfortunately, that illness and injury can strike at any time.
And as Jane mentioned previously, they might lose it, and then when they come back, then they need underwriting, yes, potentially. And by that stage, they may have other conditions which they can't get it. So, and the younger end of the population, as we all know, from 1 April, any new employees, if they're under 25, they don't have any cover at all. So it's all very interesting. I have a daughter who's in her final year at uni doing medicine, and she's actually doing work for free because it's her final year. She has to do these placements, and she's doing COVID-19 testing and things. And we had to make sure that she had all her insurance sorted as well for disablement and things. So there's lots of, even those people who are working now, who are young with low balances, it's really important at this stage. Insurance it's become, should be coming top of mind for lots of people. Yeah. So, but also, Jane, when we're looking at superannuation with all these withdrawals, it's a lot of funds that are leaving super funds. What are some of the implications for the actual super funds themselves in terms of the amount of money that's moving?
Absolutely huge, and really in a way the superannuation industry has been blindsided by the amount, the COVID payments, the 10,000, 10,000, 20, and what the implications of that. I might have mentioned before that over 600,000 people have already applied. So we're talking potentially a lot of money that's going to be leaving the funds. And the implications from the fund's perspective is obviously you've got to have the cash to be able to do that. So first of all, I think that, you're seeing the funds having to make sure that they've got sufficient cash to do that. That means they can't spend it right now. If they weren't going to be paying out the benefits, they would probably be saying, oh, there's some cheap buys out there, and they'd be buying rather than making sure holding their cash to be able to pay out their COVID payments. And then the other thing is that you've got funds here who will have unlisted assets. And if you've got a lot of cash going out the door and you've got less cash coming in the door because there's a high unemployed population, so you've got less SGC monies coming in, all your previous planning and previous strategies about how you're going to be running your money that you're looking after, other people's money that you're looking after, it's got to be re-looked at. So in particular with the unlisted assets, if you've got a lot of cash going out the door and not much cash coming back in, then your percentage of your fund that's in unlisted assets will go up. And this whole rebalancing issue is front of mind. And it is front of mind of trustees. It's certainly front of mind of the regulators. And for those that are who are old enough to have been working in the GFC as well, we have seen this before. The main thing is to remember that good unlisted assets are good unlisted assets, and you don't want to be fire selling them. So how trustees go about managing all of that is a challenge.
In terms of all the volatility in investment markets at the moment, are there any particular things that we need to be concerned about in terms of unit pricing and valuations?
Valuations. Yeah, absolutely. With unlisted assets, you've got to have reliable valuations. So whenever there is a crisis like the one we're experiencing at the moment, it brings to the front that question about, have I got sufficient market data and am I able to value these assets? So that there's equity between the members, those members who are leaving your fund, taking money out, those members who are deciding to switch into other investment options, and those members that stay. So there is a requirement in the superannuation legislation that says basically that you've got to make sure that that unit price is fair and reasonable between all of those different classes of members and those situations. And that is at the front of trustees' minds, and it goes to the heart of the issue of what value you give on your unlisted asset.
And also, I think I saw something about potential for fraud. Did I read, that the trustees might be, exposed? And what should trustees be thinking about on that?
That is in the big worried bucket list. So I'm going back to the issue of the COVID payments, the 10,000 coming in from the ATO. The ATO basically are telling the trustees, member X is due a payment. And the expectation is, of course, that the trustee will pay that as soon as they can. The AUSTRAC has changed some of the rules, so the client verification procedures that we had prior to this are not applying. So the issue that the funds are worried about is what happens if my member has been a victim of fraud, that identity theft, somebody's gone and basically been able to trick the ATO, and that bank account detail that I've got that I've been told to put the money in, it actually isn't my member's money. It's not my member's bank account, rather. But trustees are worried about that, and it is a discussion that's happening at the moment between ASFA and the government. So we've got to sort of watch this space. The industry is asking for some form of indemnification to trustees, because obviously if a member finds out that $20,000 has been ripped out of their fund and they're a victim of fraud, they're going to turn around to the trustees and ask the trustees to pay and put the money back into their funds. So that's the concern. As of yesterday, APRA came out with a couple of answers to frequently asked questions which are in this space, and certainly their expectations for trustees. So they're saying that where you have your automated checking procedures and there's no red flags coming up, they expect the money to be paid out within 5 days. But if there's a red flag in the automatic checking procedures, then they're expecting trustees to go and do a little bit more work and understand that it will take longer to pay. But having said that, they're really also saying trustees, the whole idea of this is to get the money to the members who need it as fast as possible. APRA have gone out to say that where you've followed what APRA has asked for, so that where there's a red flag, you do a little bit more work, but it's not exactly the verification processes that were previously we were rolling out, that they will not be taking any action against a trustee who pays money to an inappropriate bank account because the member's been a victim of fraud. Well, that's all very well and good, but I still think that leaves the members very angry if we do see any sort of fraud happening. And from an industry perspective, if we saw significant fraud, then that's a really big problem.
Definitely. So just going back to your comments previously about the GFC. Clearly, both of us were around at that time. Not everyone was exposed to the GFC and working in superannuation insurance, but do you see any similarities here with this pandemic? Are there any particular learnings, do you think, that we can be picking up here at this stage?
It's some of it's the same and some of it's not. I think the learning that I would recall is you do get to the end. There is light at the end of the tunnel, and looking after each other, especially looking after colleagues and being aware if anybody's suffering anxiety and any mental health issues. I think that's really important. If I go to my point around unlisted assets, they do bounce back up too. A good unlisted asset's a good unlisted asset. And often we're talking about, commercial buildings that have got good long-term leases in there, and actually nothing particularly has changed. So I think remembering that point as well is important. However, I think there's some differences too that we can see in probably the lessons that we learned out of the GFC. Some older members in superannuation funds will be in products where they're, glide path towards retirement, and they won't be as exposed to sort of such high growth assets. So there will be potentially those who are close to retirement not suffering quite the severe losses that we saw in the GFC as a consequence of product changes in superannuation funds. That's not everyone, but it is some. Some of our older members won't quite have the sequencing risk exposure that they might have otherwise had. So that's just a few that come to mind. Chris, over to you, I suppose, on the insurance side as well.
Exactly where I was going to send it. So, Chris, any similarities, any learnings that you think that will be applied this time that came out of the GFC?
Yeah, for sure. I think there are similarities. Insurers in the industry certainly looking to the GFC as a marker of what the claims experience might be that comes out of this. I would say that although it's a good market to look at, the industry has evolved since that point in time. The way claims are managed has evolved. TPD definitions have evolved as well. So we shouldn't necessarily rely purely on that past experience to form our future expectations. So, I think it is a little bit different in that sense. So we shouldn't, the industry is somewhat concerned with the economic outlook, but it does have a different feel to it when you look at the detail, and does have a different feel to it when you think, to some of Jane's points, that we're all in this together, and there is some light at the end of the tunnel as well. So.
Okay, so thank you so much for the questions that you've answered today so far. But before we close out, what I'm really interested in capturing, and this is from both of you, is what is the industry going to look like post-COVID? How is it going to feel? How is it going to, where are we going to end up after? So maybe Chris, you first.
Yeah, for sure. Thanks, Nerida. From my point of view, there's probably two key areas that are going to look and feel a bit different. So the first one being, and we touched on this, is that from a sustainability perspective, premiums and adjusting those shouldn't be the leading conversation point. It really comes down to policy terms, management. And that's something that the industry has been grappling with for the last 5-10 years anyway. So I'm really hopeful that this is a great opportunity for those things to come to the forefront, and for those elements to really be addressed and be driving forward. So I'm really looking forward to seeing that evolve and working with to focus on that, and less so on pricing. Get the claims piece right, get the policy terms piece right. That will drive a level of sustainability outside of premiums. The second point is from a general population apathy perspective. So, Australians were quite positive, in our psyche. We don't think the worst is going to happen to us. I think this type of event will give people reason to pause and think about that and think about their overall protection needs. Life insurance is one of those things that people value at the time they need it, and most people think that they don't need it. So, I think, we'll all insure our cars and our things, but we forget our most important asset, which is ourselves, right? So I'm really hopeful that it will be an opportunity for Australians as a whole to really take stock and think about what's important, what they need to do to ensure their own protection and that of their families. And, I'm hopeful that we'll see a higher level of engagement by Australians with their overall, wealth creation, but also wealth protection as well.
And Jane, did you want to add some additional comments about what it's going to look like?
First of all, I completely agree with what Chris was saying, but I won't repeat those. I'm hopeful that the superannuation industry, looking after other people's money, the members of those funds, using this as an opportunity to become a little bit more interested in their retirement savings, so that member engagement piece, that more of the community, younger people in particular, will become much more engaged with the fact that it's their money, being looked after by others, but getting involved and that communication piece between the funds and their members. I think we can see that just improving at the other side of this pandemic. Okay.
All right. I think we will wrap up the session now. We'll close out. And so thanks to everyone for listening, and also thanks to the panellists, Chris Sinclair, Head of Group Life at Mercer Marsh Benefits, and Jane Paskin, former partner, now consultant at Clayton Utz. Thank you very much.
Thank you. Bye.
Bye.
Bye.